The psychology of why investors panic sell. Have you ever wondered why so many investors panic sell? Even people who understand the market, even people who know that investing requires patience, still sell at the worst possible moment. When prices drop, something strange happens. Logic disappears. Fear takes control. And suddenly, people start selling not because the fundamentals changed, not because the company collapsed, not because the future suddenly became hopeless, but because the human brain reacts to danger. The truth is, the stock market is not just numbers and charts, it is a giant emotional machine. Every rise triggers excitement, every drop triggers fear, and the brain interprets financial loss as something deeper than money, it feels like. Survival, your brain doesn't naturally see a red number on a screen as a small temporary fluctuation. Instead, it often interprets it as a threat. Something is being lost. Something important is disappearing, and that activates ancient survival instincts. Psychologists call this loss aversion. Humans feel the pain of losing about twice as strongly as the pleasure of gaining. That means the $100 loss hurts far more than a $100 gain feels good, and that imbalance changes how we make decisions. When investors see their portfolio drop, their brain sends an alarm signal. Get out now. Stop the loss. Protect yourself. Your body may even react physically. Heart rate increases. Stress hormones rise. Your attention narrows in those moments. The brain is not designed for long-term thinking, it's designed for protection. But the market doesn't reward emotional reactions. It rewards patience. Yet patience is incredibly difficult when your brain believes something dangerous is happening. There is another powerful force at play. Social panic. When prices fall, news headlines become dramatic, markets crash. Investors panic, billions wiped out. The language becomes intense. Social media becomes louder. Everyone starts talking about the crash. Everyone shares opinions. Everyone predicts disaster, and suddenly the fear multiplies. Not necessarily because the situation became worse, but because fear spreads. Humans are deeply social creatures. We constantly watch what others are doing, and when many people react the same way, our brain assumes they must know something we don't. If everyone around you is selling, your mind starts asking, what if they're right? What if I'm the only one who doesn't see the danger? What if I lose everything? So you sell too. Not because of analysis, but because of instinct. And ironically, this is exactly what pushes prices even. Lower fear feeds fear. Selling triggers more. Selling. Panic becomes contagious. And markets often fall far beyond what the actual situation justifies, but experienced investors learn something important over time. They learn that the market often punishes emotional decisions and rewards calm. One's history shows that many of the biggest market gains happen shortly after the worst moments of fear. But most people miss those moments because they already sold, not due to logic, but due to emotion. And this pattern repeats again and again across decades, across countries, across different markets. Technology changes. Companies change. But human psychology remains remarkably predictable. Fear makes people sell low.